Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and answer any questions you might have about your subscription. See where the opportunities in the markets are and what to expect next. All right, so let's take a look first at interest rates. So interest rates continue to drop, which is positive. Below 50-day moving average, below 20-day moving average on mixed manufacturing data today. Services data was better than, services data seems to be worse than expected, and manufacturing data is better than expected. So net result, maybe concerned that services data is weaker than expected. We're a service-based economy, that the Fed will be forced to lower interest rates sooner than later. But nonetheless, I think that's positive for overall market. The interest rates is going lower. Dollar also had a sharp pullback, which is positive for the market. We have high yield, which is stable at multi-year high. VIX is at 16 level. We do have expiration, so keep an eye on volatility. I think because of the expiration, a lot of the contracts that in February, right? I'm looking at the gamma report on bar chart. Spider's gamma exposure. You can see that today, basically trillions of dollars worth of options are across all all symbols are expiring today. So pretty large movement, and people are rotating into March already. But still, this is a pretty large exposure, pretty large gamma. So we'll see what the net result of that is. Value stocks turning negative, QQQ turning negative, semiconductors turning negative, spiders turning negative. So the very large position at 610. We tried to break through all-time high, December highs. We tried to do it in December, we tried to do it in January, tried to do it in February, and for now we're back to 20-day moving average. You do have a strong support at 600, right? We had a pretty large position at 600, so this is a level I would watch as today there's an expiration, equity expiration, and then people will reposition, right, in terms of option contracts and try to figure out which strike they want to target. So for now, I think, 600 is a strong support. I don't think we're going to break through it today, but for now, I would watch 50-day moving average 6605. If you look at the stock forecast toolbox, based on one of our main models, it actually turned positive in the past few days, sees momentum that we can break through the 610 level. See 607 support, we're at 606, so market is getting to the oversold levels. It doesn't see a lot of momentum below, 605 level, right? 607, 605 level. So I think 605 level will hold. But again, today's expiration model doesn't know about the trillions of dollars worth of contracts expires today. So we'll see what happens. But overall model does show positive momentum, and assuming no new information, that we will continue, that this breakout is confirmed. For now, obviously it's not, so we have to watch it, but the passive list resistance is still higher highs and higher lows. So that's stock forecast toolbox. If you zoom out for monthly prediction, model is doing a good job predicting that for the months of February. All right, this was posted on February 1st. 620 is your overhead resistance, 576 is your support. We're at both extremes, right? Maybe not 576, but 585. And then we were at 13 is the high. So very accurate prediction. It does see positive momentum, right? So I think the positive momentum continues, that potentially we could get in Q1, Q2 could get to 625, 630 level. So I agree with the model. I think as of right now, the uptrend is intact, long-term uptrend is intact. Short-term where volatility continues, but long term that the uptrend continues. So that's the 6 months prediction. And you can use this model to make prediction for any stocks or ETFs, kind of short term, 6 months outlook. You can do the 10-day outlook or 1 hour outlook. Both can give you some key support and resistance for that time interval that you're analyzing, which is very useful. We just had a live trading room from the seasonality point of view. I mean, February is usually volatile for spiders, right? Kind of usually it goes up, it goes down, but then starting as we approach in the next earnings season, starting middle of March, usually the market continues to grind higher going into April, May. Next catalyst is NVIDIA earnings, which is next week. We'll see how that reacts, how the market reacts to NVIDIA earnings next week, and obviously geopolitical risks. Any questions? Okay, you guys hear me? Just want to make sure that the sound is okay. Let's see audio. Let me look at audio. Sound check. Okay, the audio looks fine. Okay, any questions? All right, so looking into March and April, right? Let's select gamma, right? Trading is about probability, right? It's a probability of distribution of possible outcomes, right? There is no such thing as, okay, market always goes up, market always goes down. You can have an opinion, right? But ultimately it's the supply and demand that drives the market. So based on that supply and demand, you can look at the futures contract, you can look at the options contract. I'm looking at the options contract for spiders. We can see one standard deviation, highest position right now is in 620 strike. We could be as high as somewhere between 620 or as high as 630, right, in the next, going into April. So that's one scenario, right? If the earnings continue to have a positive momentum, if tariffs are not 25% across all countries, across all industries, right, then pattern of higher highs and higher low continues, and one outcome is 620, 625. The other outcome is we're back to 585, 590 level, right? If there's any surprises, well, earnings is kind of behind us, but macroeconomic data, maybe inflation data ticks up, maybe unemployment data ticks up because of a lot of federal government employees are getting laid off. So maybe that numbers start trickling up in overall numbers for employment, or inflation data like services data is down. If the services data continues to deteriorate and housing data continues to deteriorate, then you could have kind of people look at the evaluations and might say, this high multiple on S&P doesn't justify our investment. So we're gonna, and then the market will pull back. So that would be something to think about. So when you trade, if you ever go to our live trading room, I go through this exercise and I encourage you to do the same. When you put on position, right? Let's say you have scenario one, positive outcome, let's call it 625, right? 5% up, March, April, 5% up. Right, so one possible outcome that it moves it doesn't have to move one standard deviation, it can move 2 standard deviation, right? So we can get to 630, 640 level. That would be kind of an outlier then. But 75% of the time, if you look at the probabilities, right, it's going to be something like this. Right. So scenario number one, we move 2 standard deviations. Scenario number 2, we trade in the range, right? So I think the one standard deviation said 590. We'll do 585, right? So scenario number 2, we're trading in this range between 585 and 625. We really didn't go anywhere since November, after the elections, right? This is the elections. We had this move up from the 565, 570 level, and now we're digesting since November. So obviously it can resolve to the upside, or it can resolve to the downside, right? That 2 standard deviation, unemployment ticks up, inflation is out of control, services, people spend, the consumer is weak and spending less money. So then we're back to the 605, back 2 standard deviation, we're below 585. So those are the 3 outcomes. And when you trade, I encourage you to go through these positive and negative scenarios to decide what the appropriate position size should be, right? Because when you trade, it's all about position size. And you can't really determine what the position size is if you don't go through the positive negative scenarios, right? If you're bullish on the market, you'd say, okay, this is just a short-term fluctuation. We're at 20-day moving average. I want to go long, right? Or at 600 level, I want to go long. Well, how much money are you willing to risk, right? That is the most common question. And some people say, well, should I always buy 10 shares, or should I always buy $10 worth of $100 or 100 contracts? I encourage you to kind of rewire your thinking about trading and just think about the risk, right? It's not how many contracts do I want to buy or how many shares do I want to buy. It's what is the risk I'm willing to take to support my opinion that the market is going to reach 625, 630 level. Okay. And the way you do this, you look at the stop level, right? If you're a day trader, you might say, okay, 20-day moving average, 605, stock forecast toolbox, set 605, I'm a buyer. Okay. Or you can say, listen, I don't want to day trade. It's, I don't have time. So I'm going to use, 50-day moving average, 600 level as my buy, right? Or you can say, Vlad, we were at 600, a couple of days ago. I'm not comfortable. I'm going to use, 585, 580. Yeah, right. Year to date low. So whatever your stop level is, based on your time horizon and how, how aggressive you are as a trader, right? Because we all go through a different journey, right? Some people, based on your profile, right? Personality profile, you could be aggressive, kind of direct, right? Kind of like to make quick decision. Maybe you like to day trade, or your personality could be kind of a very methodical, slow, kind of very mindful, and then you like to take longer term positions, and you have patience, so that's fine. So at those levels, but the idea, no matter what your personality is and psychology profile is, right, the risk should be similar, right? Doesn't matter how long you hold in position, what your profile is. I would propose on 10,000 average account, a Tradespoon is $10,000 based on our survey. So if you have $10,000, then I would use 2.5% per position. And I propose not to risk more than 4 positions, especially if you start. So 4 position, 2.5, that means you're risking 10%, right? If this pullback continues, right? It got rejected in December, it got rejected in January, right? And we had, this was, I think, what, 5% pullback, 30 points, yeah. So we had 5% pullback, we had whatever, 3% pullback. This could be, again, 3%, could be 5% pullback. So it could be more. So then the idea is that, but you always risk in 4 position, 2.5, so no more than 10%, right? Because if the market reverses and you're down 10%, I mean, nobody's happy about that, but that's, you can regroup, you have cash, and you can deploy it in the right place, with the right attitude. But if you're down more than 20%, this is where you trade, your adrenaline goes up, and you make kind of a quick decision based on emotions, which in general you want to avoid. And the only way to avoid it is to avoid large drawdowns in your portfolio. So how many of you say, one, Vlad, we're going higher? We're saving a lot of money in the government, we're going to resolve our debt issues. The economy is strong, people are spending money, they're traveling. We're going to 625 and above. What do I think about Robinhood brokerage? I mean, they're just like any other brokerage. They're regulated, but they're very fast moving. I mean, for option trading, probably not the best platform. For stock trading, I think it's fine. There are a lot of brokerages you can consider. So higher. Chuck, 2. Okay, so we got 2. Somebody said done. Hire 1. Andre 1 1. Okay, so a lot of people said 1 1 1 1. Okay, most people said 1. We had few 2s. I'm gonna go with 2. I don't think I think the 620 strike will hold at least until probably next earnings season, April. Maybe in May we'll break it, but by April, before the next earnings season, I think we're not gonna move 2 standard deviation. We're gonna trade somewhere between 625 and 590 level. So continue to trade 2. I'm going with probabilities, right? Because I know this is 70% probability that the stock is going to trade between 625 and 585. So for that reason, every time you see that the market reaches these levels, this is where you want to trim your positions, right? If you see overhead resistance, you want to trim your positions, at 600, 585, 590. This is where you want to start deploying some of your cash and get a little bit more aggressive and bullish, right? But when the market is overbought, you probably want to trim your positions and raise cash. And when the market pulls back, you want to do the opposite. So that's my outlook. Any questions? So in terms of, some of the recent trades, so you can sign up for Elite Circle. This is where I trade, basically both stock and options, right? So you can see, let's look at past couple of days. Walmart, right? So I have a Walmart position. I closed the Walmart. So I do option spreads. Sometimes these are short-term trades, like an example of Walmart. Some of them are calendar spreads. Some of them are verticals. Some of them are short-dated. Some of them are more of a long-dated options, right? Like I think I have a position in IWM, right? So I have a hedge in IWM put spread because I think IWM is a good hedge, and if the market underperforms, then IWM will underperform more than others. And in this example, I'm right. So that's option position. But I also have stock position, right? So Texas Instrument, I'm long Texas Instrument, try to close at 206.10. Texas Instrument had a strong move. So it's a combination of option and stock trades. And I trimmed Morgan Stanley yesterday, right? So Morgan Stanley was also a good performer, trimmed half of the position, sharp pullback. Now I want dust to settle after the expiration, right? And then maybe next week, if we don't break 50-day moving average and this level holds, maybe, buy those shares back. Any questions? So that's Elite Circle, right? Combination of stock and option trades. You can participate in Closing Bell and Morning Bell. We have Keith from Options Hotline joining today and every day, almost every day he joins us. We have a joint program, paid program that you can also participate. If you don't have time to be in a live trading room, you can always watch the recordings. So Elite Circle is a program that can give you that exposure. And then you can enter your either Discord or on SMS message, type in your email, type in your phone number, and you'll be able to get text messages every time I trade. And you can also see the recordings. So that's Elite Circle. We already talked about if you're active trader, or if you already have a trading plan and you know what you're doing, you're just looking for signals, right? So we have a software, AI software that uses latest advances in neural networks and machine learning, and it's finding signals in the market based on the long-term, short-term horizon. So if you're just looking for the short and long-term signals, then active trader, weekly trader, and monthly trader. These are the signals. Active trader gets the program, the software learns on the data and makes inferences every day. So you have signals every day from active trader. Longer term signals gets generated on the weekend. So on Sunday, we publish weekly trader and monthly trader. And then I look at these signals and, I trade them, right? So Capital One Financial, Discover Financial was one of the trades that I just closed based on these signals, right? So you can type in COF or Discover Financial, and see that in this example, I traded option spread, right, which I closed. What are the $3 closed at 370. So this is an example of how I personally use these signals to trade, right? And you can use let's say you don't have industrials and you think Boeing can continue its uptrend, right? It's been one of the better performing stocks in 2025, and maybe all the worst, if you're contrarian and you think all the worst news in Boeing are behind them, okay, then you can buy Boeing, right? If you want exposure to financials, Discover Financial. If you want exposure to technology, high beta stocks, okay, Palo Alto. We have a signal in Palo Alto. So these are the signals that you can use. We do suggest entry and exit points, again, generated by Stock Forecast Toolbox and our software, but these are just the guidelines. You would have to have your own trading plan and make a decision. Do you want to risk 1%? Do you want to risk 2% of your portfolio for each of these trades? And I do encourage you to either use option lettering or dollar cost average when you execute these positions. Any questions? Thoughts on Pelletier? It's a typical gamma squeeze example, right? Everybody wants to own Pelletier, everybody is buying calls. The dealers have to sell those calls, and on any negative news, dealers have to close their position. And you have this above average volume and a 30% drop in one day. So at this point, usually when you have these 20-30% drops in one day, that means some kind of a digestion, consolidation, probably till the next earnings season. So for now, the gap, it held the 20-day moving average. So 100 is your strike, 130 is your overhead resistance. I would consider, if you're short-term aggressive trader, maybe buy at 100, but I would trim at 120, 125. It got sparked by the idea that Department of Government Efficiencies will cut some of the budgets and maybe some of the grants or some of the contracts with Pelletier, and that sparked a concern, right? So, and you can see it in an Nvidia stock, you can see it in Microsoft, Google. This is not just one stock, but obviously 25 alone, it doubled in price. And triple its price since 2024. So sometimes some period of digestion you need. So in my opinion, for now, it holds 100, 120, and then depends on the market, right? If spiders continue to deteriorate, right, and we get to that 580 level, well, Pelletier most likely is going to sell off as well. Plus, keep in mind that we have Nvidia earnings, right? And if you look at the Nvidia earnings, also kind of been going nowhere for a long period of time, right? We're going back to June of 24. So for the past 8 months, Nvidia is flat. So it's a pretty long digestion period, right? It's still pattern of higher highs, kind of a ascending triangle. After the earnings, right? The earnings is next week. It could resolve to the upside if the earnings are better than expected, right? The bar is set high, but it could break to the 150 level, which it wasn't able to. Or if they're unable to justify their evaluations, then you could have a sharp pullback to 200-day moving average. So Nvidia is kind of a next catalyst for AI stocks, and including Pelletier. Credit spread, Chuck. Debit spread or credit spreads usually looks at the volatility, right? So if your view on the volatility, if you think volatility is going to expand and continue to go higher, then you would do a debit spread, all right? If you think that volatility is going to collapse, right, VIX is going to drop, or volatility of underlying stock is going to drop, then you sell spreads. If it's the same strikes, it doesn't matter, right? If you're doing the same, 90, 95 strike, doesn't matter if you're doing put spread or call spread, it'll be the same. Any other questions? All right, so what are some other services? So we talked about signals, right? It gives you entry point, exit point. It also gives you options. If a lot of people want to leverage their trades, so you can go to options tab and actually see the options. Thank you, Joseph. Thank you very much. So you can find, option trade and trade options as well, right? Today, Pinnacle, PNW. So you can trade monthly or weekly options if you want to. But the exit and entry are also used based on the stock. It's just instead of entering the stock at $84, $89, you buy an 85 call for $4.15. Or instead of buying stock at 89 or 90.75, you buy 85 call, 575. Obviously, if it's a monthly contracts, there's time premium, so you might have to adjust for time premium, or you might just want to wait for the price to entry. But why two entries? Dollar cost average, right? So the idea is that I don't want to risk more than 2.5% of my portfolio per position, like let's say PNW. But I don't know if it's going to continue going higher. It might pull back, right? The model does show that it has a strong momentum, but stocks don't go in a straight line, right? They usually go up or down, right? There's some kind of a sign, wave movement. So in case it pulls back, I want to be down only 1% of my portfolio, right? So let's say my stop loss is 1 or 2%, then once that support stock pulls back to the support level, if I'm down 2.5%, I have to exit. Doesn't matter what the support says. Support might be broken, then I'm out of the trade, right? If my maximum risk has been reached. But if my maximum risk has not been reached and it pulled back to support, then I want to make a decision, right? Do I want to participate in this trade? Anything changed? So for that reason, I encourage always to not to risk 2.5% of your portfolio per position, but only 1% of your portfolio. It depends on how much money you manage, and it depends how many positions you have, how much experience you have. But in general, if you're risking 2% of your portfolio per position, do only 1% per trade, where you would enter the trade, you look at your stop level, any stock, let's say NVIDIA, right? Let's say you bought on NVIDIA, 130 has been a strong support. And NVIDIA could drop to 130, right? Very quickly. We've seen these sharp pullbacks in the stock. So same analogy, I would look at my main support, okay, 50, 20-day moving average, 130, and basically say, okay, this is my stop level. If it reaches 130, I want to be down only 1%. And then you can make a decision, right? Based on market conditions, do you want to just exit that position if it breaks through the 130 level? Or maybe you want to add, right? Maybe you want to add because you like NVIDIA and you think long-term it's a great buy, right? But one thing you want to avoid is NVIDIA drops to 130, you down 2.5%, and then you're using kind of this prospect theory, right? We talked about prospect theory that you can, when you're faced with the 2% gain or 2% loss, we treat them differently, right? 2% gain, we usually close the position, but when the position is down 2%, you kind of convince yourself, right? Because we want to avoid the pain, right? Our relationship with pain and pleasure is different, right? In general, we want to avoid pain. So when the market drops and you're down 2.5%, you can convince yourself that, well, maybe 120 level will hold, right? But if it does drop to 120 level, now you're down not 2.5%, but 5%. So you want to avoid the situation and we're all wired similarly, right? First step is to kind of recognize that the prospect theory, and this is, well-established theory, right, by Tanyan Cannon. He got Nobel Prize for this, and it's studied in every financial course. So, if you're a finance degree, everybody studies this, and it affects everybody, including me or most people, not everybody, but majority of the people, right? So this idea of loss aversion, right, and diminishing sensitivity, right? Stock is up $100 to $100, you feel great, you close your trade, but you're down $100 to $100. Then your adrenaline is pumping, and you make a rash decision. So I encourage you to study prospect theory. He does have a book, Daniel Kahneman. Right? He has a great book, Thinking Fast, Thinking Slow. Right? This is a great book where he talks about actually prospect theory, utility theory, self-serving bias. And the idea that we make decisions in two different modes. System one is fast, instinctive, emotional, right, primitive. part of our brain. And then system 2 is kind of a slow, deliberate, methodical system. So it's very important to first recognize that we make decisions by different parts of our brain. And when you see that, you want to kind of, sometimes it's better, right? For survival, you want to make fast decision in system 1. But if you're managing your money, you probably want to use system 2 most of the time, right? So it's a great book. And as a homework, I encourage you to read it. If you haven't read it, it's going to make you a better trader for sure. So Daniel Kahneman and Prospect Theory and Thinking Fast, Thinking Slow. Any other questions? All right, guys, that's all I have to do. I have for today. Consider joining one of our elite service. We do give you 30-day money-back guarantee. You get access to live trading room. You get signals for 30 days, and if this doesn't fit your style, you can always ask for refund in 30 days. And I hope to see you in live trading room. Keith will be back at 2 p.m. and hopefully you can join us. Thank you very much, and have a great day. Chuck, I think yes. So personally, I trade cover calls. I think cover calls or mirrored puts, right, are the best strategies, but you need to have a larger portfolio, right? So instead of selling, put spread or debit spread and being tied to time, cover calls or mirrored puts, you don't have to be correct on timing. But that to be diversified, it does require a large portfolio. So if you have a large portfolio, usually mirrored puts, cover calls, they're giving you that extra hedge or extra income in addition to stock growth. But you would use the same stocks instead of Capital One financial spread. You would just buy Capital One financial stock, and if you think it's going to continue going higher, okay, you buy a put, right? Hedge yourself in case market does pull back, 5 to 10%. So just like you buy a house, you always buy insurance. So it's same thing. So if you have a large portfolio and you can be diversified, then yes. On smaller portfolios, sometimes it's hard to buy 100 shares of Capital One Financial because you're going to use up all your buying power. All right. Thank you very much. Have a great day, and I will see you guys shortly. Thank you. Have a great weekend.